Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best that you can be. My name is HarveyBracken-Smith, and today I'm doing a new type of episode, Personable Markets, in which I aim to speak every week to a new hedge fund manager, VC, or investment banker about the latest news and market events. Stephen Roberts is the founder of Orgueil Capital, which is an investment vehicle with its North Star to quintuple capital over the next 8 to 9 years. He is also a former partner at the Hedge Fund Horseman Capital. Stephen, I'm incredibly excited to speak to you today. I wanted to get started by asking you, what are the key themes that you're seeing in the market at the moment?
Well, I think as far as markets, the thing that I think not enough people are talking about is how well the Hang Seng's doing. The Hang Seng's up 27% this year, but it's getting sort of very little airtime. It looks like it's the index that's going to be the best performing index this year. And there's a lot of negative rhetoric around China and trade talks and Trump. But I feel as though investors really are missing, one of the biggest opportunities sort of out there at the moment. So that's the thing that's getting me excited at the moment.
Why do you think people are so fixated on the US the whole time? We were actually speaking earlier in the year about people needing to look more towards Europe and China. But even when the US isn't doing well and gets more concentrated into the Magnificent Seven, it still seems the overemphasis from both retail investor all the way up to hedge fund. Why is that emphasis, solely focused on the US? And what should investors be looking at to, diversify over to Hang Seng or other investment opportunities?
Well, it's like everything in life, where everybody's at is the biggest risks. People love talking about AI. A lot of people still don't really understand AI. I'm saying the retail investors. They all know Nvidia is that big stock that they need to play AI, but they're really not looking at the valuations and the risks in those stocks now. There's themes to play within AI, but I personally think people don't understand the valuation they're paying for these businesses. When you look at AI, also, really, the competition is China. Most open source now is taking place in China. If you look at China as a country, I would say, if you look at their autonomous, what they're doing in autonomous technology or car technology or robotic technology, I would say they're leading the world on this. And really, the American investors just are missing a trick, really. I think they're just too fixated with the US is the superpower that's gonna win this game. I personally think, don't be too confident about that.
Yeah, I think I saw a headline a couple of hours ago that Alibaba was up something like 17% on the Hong Kong index on account of the success of their cloud computing. What do you think is the big, you kind of touched on it there, but what do you think is the big value opportunity in China? And do you think should be any concern with regard to risk with China? Because the media often portray China as sort of the enemy of the US with all these military parades, being against. And then on top of that, you have trouble with Chinese delistings on the New York Stock Exchange. So is this something that investors should be worried about with China, or is the value so great that these risks, are pretty small in comparison?
It's like every country. What country isn't a threat to America? It was India last week. It
Yeah.
was China 3 months ago. It was Europe 4 months ago. So, I would argue that this is pushing other nations. Now, you're seeing today in the news, China and India buddying up. That they generally, as a nation, they were sort of competing forces. They weren't that aligned. And now, what it's doing is the policies are pushing other countries to sort of forge new alliances. As far as the delisting risk, there are risks around that. You know, Alibaba could be delisted from America for their ADRs, but the majority of the volume of this business goes through the Hong Kong listings. So whilst it might be delisted in America, does that really affect the fundamental business of Alibaba? It's got very little business in America. So therefore, but these things are very important when it comes to sort of country risks. And if the rhetoric between Trump and obviously President Xi really gets fiery, then these stocks will suffer because people just de-risk out of them very quickly. So I'm
So
not
you're
saying this is an easy trade. I'm saying you need to be very aware of the country's sort of geopolitical risks.
So you're saying that with the risks that are going on in the US, it's not just about, the US is getting in trouble with China, with India, etc., but that's creating opportunities elsewhere for them to do partnerships with one another. Is that basically what you're saying?
Yeah, I'm saying, Alibaba now, if you look at, say, BYD, obviously a very big car company in China, they've got massive growth now overseas. Their businesses in like Mexico, Brazil are booming. Now, if you're a Mexican or Brazilian, you know, do you want to buddy up to China? The likelihood is you probably do now, given what the US, how they've sort of, how the US has pushed away from those nations. So therefore, where you see America forging sort of now, more sort of bridges, it's really opened the door to China, and you can see this in, say, businesses like BYD. So if you look at overseas sales of BYD, they're exploding. Where if you see overseas sales of Tesla, they're collapsing. So that is the opportunity as an investment manager.
Yeah, I also saw with other companies such as Neo did really well in China as well. But with regard to China, what are the specific, you've touched on one there with cars, but what are the specific themes? Is it AI? Is that still the biggest theme in China that presents the growth, or are there some other industries as well that you think could present a great opportunity?
Well, if you look at China, say the online business, if you were go over to China, still people are going to the local stores, and I would say they're 15 years behind as far as sort of shopping on the internet. So you've got a structural bull trend as everything goes, from obviously onto online platforms. So there's a massive structural trend there. You've obviously got increasing wages now coming through. You got standards of living improving. So for me, the whole think of China as 15, 20 years behind US, and now they're applying technology and really changing the way people shop and consume, and yeah.
What are some big misconceptions that people have about China? Because me, for example, you see this sort of centralization around media. Obviously the earnings and everything are public, but you see the media coming from these central sources versus the US. You have people on social media, you have tons of platforms from the left wing to the right wing. So how should people go about getting their information on China to, find their edge and to find out information that other people wouldn't be able to work out just from looking at the earnings report, but
I
actually,
was,
learning from boots on the ground?
I watched, when I say what, I read the China Daily every day, and it just gives you a very basic insight into how, what Chinese policy is doing. They're very pro tech at the moment. They're very, pro, decarbonizing. So the picture the government are painting of one of very much on the front step with things like that. AI, again, is something that they're really leaning into. Obviously, Nvidia, they can see the threats that Nvidia are now sort of pushing on Chinese businesses. So, I think it was 2017, 2018, the Chinese government put many billions of dollars into trying to find sort of a chip similar to Nvidia. So I think at some point, you know, all these things are going to interplay. And as a US investor, you have to really be watching this stuff. Nvidia share price could halve because of threats from a cheaper rival from China. If that happens, it's 2 trillion of market cap disappears overnight, and that's going to cause probably a 10-15% correction in the S&P. I find it remarkable that people aren't watching what's going on in China.
Well, I think there's a thing from most investors is everyone is telling like, everyone, across the board is saying that AI is the next biggest thing. And then you go one tier down and you look at what are the companies worth investing in for AI. And Nvidia is consistently, both in terms of market performance and in terms of actual how much revenue they're getting in from AI, they seem to be the biggest leader, even if that is massively inflated. So where else should people be looking, both in the US and in China, in terms of investing in public equities for AI? Is there a play that can be made, or have many of the plays already been made, and you think a correction is the next likely thing.
I'm not saying there's going to be a correction. What I'm saying is stocks like Nvidia are pricing that there's probably never going to be any competition, and I think that's dangerous. And we saw this sort of they had this open AI moment in China. I think it was in January, February, when they launched DeepSeek from absolutely nowhere. I'm not saying they're going to do that with an Nvidia-like chip, but there's certainly there's now a sort of war going on within even China, Japan, Europe, who need to build something similar. Now, many people are saying they're years behind, but they said this were OpenAI and DeepSeek.
Yeah,
But
DeepSeek really. Go on.
yeah, as far as investing in AI, really you don't need to be that clever with it. Ultimately you've got Amazon, you've got Google, you've got Microsoft. You're going to have obviously quite a few IPOs come through, but a lot of these businesses that are coming through, even on IPO, they're still heavily loss making. And businesses, the equity markets don't like businesses that are heavily loss making. They can't get the valuation. Obviously private markets, they can get much bigger valuations where they're loss making businesses. When you're in sort of the gaze of analysts in the street, you really need to be generating free cash flow. You need to be having sort of completely different dynamics to get that valuation. So private markets still are the place to go as far as AI.
Well, do you think there should still be a focus on the Mag 7, consistently continuing to drive forward AI returns? Even looking at Mark Zuckerberg and putting out reportedly nine-figure deals in order to get the best AI researchers. Do you think these companies are still worth investing in? The only reason I asked that question is looking at Google, in which I think Perplexity offered to buy Google Chrome because of struggles with the competition authority, and whether as these companies get even larger than they already are, whether the competition authorities around the world will say, hey, you're too big, we have to split you up. And so it might be worth looking at smaller companies which have more of an ability to grow, or whether you think that's not even a risk worth thinking about. They've got the best talent in the world, the most money, and so they're going to continue to grow as oligopolies.
I think the big issue with the big tech is Trump has effectively given them all the green light. They're not really paying much tax. Regulation now looks like it's going to be easier. And all the trade wars currently are all taking a place around physical goods. Now, the EU has not pushed back and said, by the way, Google, Microsoft, Nvidia, all these big tech companies are hardly paying us any tax because they're obviously, these are servers that are based offshore. And, Trump has got massive pushback with any type of conversation around that. These businesses really, quite frankly, are getting away with murder as far as, paying tax, certainly in other countries. Now, with Trump at the helm, I think you've still got a green, it's still all go with these stocks. What's going to eventually kill these stocks is where they're probably not paying enough tax and governments go after them and start regulating them much more. And that, for me, is a key risk. And, if any competition comes around, they'll either now go in and buy the business. Now, that's becoming more difficult. So what they're now doing is just going in and getting the talent. So I just think you're going to see more of that.
From more of a political landscape perspective, the US and China have been in talks to do a trade deal. Do you have any thoughts about what the market's pricing in with regard to a potential US-China trade deal? You think this is something that they want to try and achieve? Even going back 6 months ago, when there was sort of the Liberation Day occurred, and there was sort of the tariff war between the US and China, with tariffs reaching over 100%. What do you think the end goal is for both Xi Jinping and for Donald Trump in this potential agreement with the US and China? And do you think is the market pricing something in that there might be something soon?
I think as an investor, you have to expect they're not going to get on. Um, you know, China is a major superpower, and I think Trump sort of went toe to toe with them, and he realized that they were bigger than what he was expecting. They didn't roll over. And they were like, okay, if you want to put all these tariffs on, then put them on. And the Chinese economy didn't roll over. Okay, it slowed down, but it didn't roll over. So I think China's proven to itself that actually, with Trump at the helm, they can do a lot more JVs with the rest of the world. So they're just sort of standing back and letting Trump get on with it. But ultimately, for me, Trump is playing a game that probably China's beating them at the moment. And with things like rare earths, they've got some big sort of cards to play, China. And the US economy has got huge excess debt. And what Trump can't afford is the bond market selling off. Now, if that does happen, and if anything, China controls that at the moment. So whilst you've got so much debt, sort of aggravating sort of not only your biggest lender, but also a country that can give you inflationary problems. I personally think China is in a stronger position than it thinks.
What do you think will be? I mean, quite a few different points there from the political landscape to the debt, to the tariffs, to private markets, and more that I want to delve into there. But just sort of on that topic of debt, obviously Elon Musk came in with Doge. Plan was to cut out billions in excess spending to reduce the enormous amount of debt that has led the US to continually raise their debt ceiling, which had got to a point which was so worrying that people, I think the US credit rating went down from AA, from the top rating to slightly lower. What do you think is going to be the result of this constant snowballing debt that the US keep accumulating? Do you think there will be a way out in which this debt to be reduced? Do you think that the GDP growth will just outweigh the amount of debt that they will accumulate? Do you think that's even something that they should or will think about moving forward? Like, what does the US debt look like now? Is it still as big of a story? And are investors still worried about it? Obviously, the debt ceiling's been raised, but how does that sort of form in your thinking?
Well, the reason why Trump is pushing the Fed to cut rates is he needs to get growth going. And like every problem, certainly when you got debt, if you get growth and you get GDP going, then it sort of sorts itself out. Now, obviously, Elon Musk is in much more of a you need to address the deficit now before it gets out of hand, and didn't have so much of a growth agenda. It's clear now Trump with deregulation and what he's done with tax policy, he's going all out for growth. And he's basically saying these tariffs are going to help pay back, obviously, these debts. So,
do you think they will? Do you think they will?
Well, I think they're definitely going to help. They're definitely going to help, and there's definitely been a big corporates now realize they do have to put more of a presence in China, in America. So I'm not saying Trump policies are completely out of whack. I think the balance between the two is a difficult balance, but I think now's the time to go for probably all-out growth, get the Fed to cut rates, prove that these tariffs aren't as inflationary as what people think. And, we could be looking at the US economy in the next 18 months sort of starting to pick up again. It's definitely slowing down at the moment. We got jobs numbers on Friday. That's probably going to show that more. Housing is obviously an issue there. There's been this big slowdown in that. There's big slowdown. The car industry's seeing big hits in America. So, the consumer is not, feeling all that well. Really what's holding up the US economy is AI.
Yeah, I mean, if I was to go back 500 years ago, there was the relationship between the state and the church and the influence that religion had over politics and vice versa. But now it feels like it's the state versus the Fed. And for a number of years, these two were sort of independent with both policy making and also with the federal fund rate, where they set those rates and the implications that had. But Trump, I think he fired Lisa Cook, who was on the Fed, and it's sort of seeming that these two usually distinct things are starting to connect into each other. What implications do you think that will continue to have with Trump's continued involvement into the Fed? Is this something that people should be worried about, or do you think could lead to more growth moving forward, which will be overall a net benefit for the US economy?
I personally think people all should be questioned. Um, you know, you look at now the Fed, they got the inflationary spike wrong, and they don't want to see an uptick in inflation because that would be have serious consequences for the US economy. So they are very cautious. Now, if they didn't have this bad experience, of 2020, 21, 22, 23, maybe rates would be a lot lower. And so therefore it matters what optic you look at that. But I personally do think, the Fed is behind the curve. They need to start cutting rates. Because if you look at, inflation and where interest rates are, they're well above neutral. And there's certainly big pockets of the US economy that's struggling. So, if you remove AI, which is really, 6 or 7 companies globally, people aren't doing so well. So I
But
think
do
we
you,
need to look at that.
but do you think they will hold it merely out of spite? Because I wasn't as involved with the news and understanding what's going on with previous presidents as much as I have been with Trump. But that's also just a case of getting older. But I didn't really know that the president and the Fed would have so much involvement with one another. Like, is this a normal circumstance in which the president is firing members of the Fed?
No,
Previously he was calling
no.
for Jerome Powell to step down. Now he's saying, he doesn't mind. He does mind. How does that interaction shape up markets? Like, what do you think will be the overall implications and the end result of this from a market's perspective?
I think, presidents should have a view on interest rates. Obviously, Trump has because of his background. And, Biden, for me, didn't really have much of a skew on where rates should be. I think he got advisors, but Trump is, I think, a bit more on the ground. He's got many more businesses. He's talked to many more business people. So, Trump is a markets president. And he's a guy who doesn't hold back clearly. So he says what he thinks. And, people might not like him for that or love him for that. But ultimately, that we are where we're at. But I'm in the Trump camp. I personally think they need to cut rates. I don't know if that answers the question, but being political, this alignment that, these guys can't be questioned. I don't believe in that. I think they should be questioned.
Do you think there's any case in which the Fed hold rates merely out of spite because President Trump's telling them to cut, they would keep it? Or do you believe that, at the next meeting that they will cut rates or cut rates multiple times in this year? Because I think
Yeah.
since, December, they've held rates right at 4.5%. So like, do you think that they will actually have some decision making to eventually cut rates? Or do you think the political side has got too involved to which they won't actually do anything?
I'll be honest with you, Harvey. I think this whole rates conversation, if you look at the 10-year Treasury over the last 2 years, it hasn't done anything. I think investors, to really make money, yes, you don't fight the Fed, and if you cut rates in September, that's now being priced in. The Fed is probably a bit behind the curve, but you can argue lots of different ways why they are. Um, the big thing in markets is really where the travel of interest rates is, and I think all market participants would agree that in the next 14 months, 15 months, we've basically got an interest rate cutting cycle, and we can all argue where that should start or end, but ultimately we are in a cutting cycle, and I think that's really all investors need to think about. I think there's too much emphasis is on the Fed and Trump and media, and I personally think that just puts people off actually doing the work on other things in the market. There's an obsession with Nvidia, there's an obsession with the Fed. We're even talking about it, but I'll tell you now, that's where the money's not being made.
Yeah, that's a really interesting perspective. But I guess whatever it would be, you would need people to overemphasize and overfocus on other things in order to find opportunities that people aren't looking at. Sort of from a just on that rates point, sort of one other thing I've noticed is that compared to the Fed holding rate, the Bank of England, I think, has cut rates 5 times since August last year. How does that sort of compare from a market's perspective from the US to the UK with cutting rates? And to what extent has this cut of rates spurred growth within the UK particularly with the political backdrop that is currently going on within the United Kingdom?
I always look at the UK as 6 months behind the US. So, which is more or less where they're at. The
Can I
UK
ask why? Can I ask why you look at 6 months behind?
it's bizarre. Their economies are sort of quite, in some ways, they're different. But if you look at current interest rates, they're the two countries that are very much aligned. If you look at the yield curve and everything going on with the yield curve and where interest rates are, these two countries are very aligned. I can't tell you exactly why, but they're just very aligned. And ultimately, if you see the Fed cutting rates, it allows all of the central bankers around the world to do the same. The Fed leads. The Fed leads on this, and they always have done, and the Bank of England's always followed.
What do you think is the impact being faced by consumers right now? Because if you talk, I often think a good way to reflect of what's going on in the boots on the ground is when you're in an Uber or when you're speaking to the man on the street, how they're feeling and how much money they feel they have in their pockets. And for sort of the last year or even 2 years, there's been a strong emphasis from people that I've interacted with that they
Right.
don't think the economy is doing that well, that they don't have money in their pockets. Do you think that consumer impact in the US is actually like a real thing? Do you think people are struggling right now? Do you think things will get better as inflation continues to drop, as growth continues to spur? Is this more of a symptom or a deeper cause that people aren't really looking into?
Oh, that's a difficult one because if you look at the US economy, it's obviously doing well. It's creating jobs. There's a bit of wage inflation. You can argue wage inflation is sort of above core inflation. So, now we're getting the positive effects of that. Savings ratios are still, I think, like 4.5% in the US. So people are sort of saving a bit. If you look at the UK, the savings ratios jumped up to 12%. And the reason why that is because I think there's more uncertainty with the government in the UK, and just people post-COVID have got used to having a bit more savings, and they haven't really gone and used those savings. But also, if you look at money market accounts, there's record amounts of cash sitting on money market accounts. And the reason why this is because, they're being paid, 4%. Now, that hasn't happened for a long time. So higher interest rates in itself are restraining growth because it's making people save more globally. And, I think the balance between the two is now out of kilter. 4% risk-free rate on your savings for me is too high. It is certainly if you've got inflation normalizing. So I personally think, the economies look good. They look okay. There's not massive growth, but I don't see massive threats of a recession either. So I just think, economies are going to grow, at, I don't know, 2-3%, a little bit. Probably inflation is going to be slightly elevated for a while still. But ultimately, I think everybody's just going to sort of chug along, really.
Yeah, a number of years ago, there was the whole thing with GameStop, in which obviously that went to disproportionately large amount for the stock price of the market cap on account of people on Reddit deciding to just pump money into the stock and as a consequence making a huge amount of money from it. And then they did a similar thing with AMC. And there's still a big thing of retail investors just banding together and pumping money into stocks. And I think retail investing on the whole, even if you look at the price of Robinhood stock, so many people, as you just mentioned, are putting their money into accounts to invest. Is that something you look at? Do you look at what, retail investors are investing in and have the implications of? Because when you have them all together, they can have quite a big impact on some random stocks that you wouldn't have even thought about? Or is the overall impact so small that they're not even worth thinking about?
Retail's so powerful now, and you need to know what they're doing. I now listen to podcasts. I have to go onto these sites to see where sentiment is. The gold price, a lot of retail are going into gold. Gold's up again today. It's a very big retail product now. Um, so retail is certainly driving things like Bitcoin, obviously big retail, gold, big retail, stocks like Nvidia, Amazon, Meta, big retail stocks. So, the sentiment around those names, you need to see what the retail's doing, and you need to see where all those risks are. So,
Do you have any like, go on?
yeah, it's key to know what retail's doing. There's no question. As a money manager, you really need to know.
But what way are you finding this information? Like, do you have any? You mentioned podcasts. What are the names of these podcasts? How are you finding this information? Because when I was on Bloomberg for a bit, I saw they kind of had these automated things to say here are tweets from various accounts of what retail investors are looking into. But it almost seems that the news has a slight delay, a lag in terms of, oh wow, this stock is already up 500%. But that's, after the fact. Like, have you found a way in order to be in the group chats with the people, working out what's actually going, boots on the ground, understanding? Like, how are you monitoring what's going on with retail investors and the subsequent implications that has?
Okay, so I as an investor look at all the biggest movers and all the biggest gainers and fallers on every index. So I go through the CAC, the DAX, the HSI index. I go through the S&P, and I look at the biggest winners and the biggest losers. So that is the really good way. Doing that every day is a really good lesson in just seeing where money's going and where money's being taken out. So as you pointed out, Alibaba, I think, was up 17 or 18% today in Hong Kong. And that's because a lot of now bots trade that stock. And they mentioned the word that they're building an Nvidia-like chip. And now people are saying, okay, this is, and Nvidia sold off heavily on Friday on this. And obviously a lot of money is being funneled into Alibaba. So retail has driven that, because what retail like. Retail like the word AI, and certainly, a competitor to Nvidia. So you can think of all the bots all over the world who are registering that. So in some ways now, a lot of CEOs of companies have got their marketing departments, and and what they're trying to do is put AI into the sentence so many times, because
Yeah.
this is now what's driving, equity markets, and that's very different to how it was, 15, 20 years ago. So when I read a company statement now, I know what the bots are looking at, and I know how the bots are going to react.
When when you say bots, are these retail investors, custom built bots, or are these more quantitative hedge funds that have bigger strategies? Like, are these smaller accounts with tens of thousands, a couple hundred thousand, millions, or are we talking tens of millions, hundreds of millions in these accounts? Like, is it more like lots of people with an amount of money, or is it big fish,
Okay, but
automation accounts, or both?
something like a Citadel will have AI looking over every single. So when a company like Nvidia, I'm talking about Nvidia because everybody knows the business, but when they announced when they had their conference call, so they had their conference call on Thursday or Friday last week, and all this transcript of that has got AI bots that are pulling out keywords. And Bloomberg do this as well. So when that conference call's on, they basically put out sort of sound bites onto the screen, and those sound bites are basically now taken all over the world from all different people. Now it could be a private client sitting in Singapore trading that, or it could be Citadel trading that. But ultimately, they're all looking for these keywords. Now I'm much more old school. What I do is I actually listen to that, and if I don't listen to it, I read the whole transcript 100%. A lot of things are missed from just these AI bots. I feel, and I just think, for me as an investor, I actually read everything. I read the whole thing 100%. I just don't take these bots, but I know in the short term the bots move the price.
What's an example of something that you would pick up that a bot wouldn't from listening to it?
I listened to a podcast, and basically the podcast said that 50% of the revenues of Nvidia are going to, I think it was 25% of the revenues of Nvidia are being billed in Singapore. And the podcast basically said, the podcasters basically said, that's all Chinese businesses. So therefore, actually, without And as an investor, I'm thinking, well, is Nvidia actually selling their GPUs into China? And they were basically surmising that they probably were. Now, during the call, that was addressed. What they said is, I think 25% of the revenues of Nvidia are billed in Singapore, but 99% of that is actually US businesses. So they sort of answered that question in a roundabout way. Now, a bot wouldn't have known the context of that and how important that was. And this is in a lot of research I read, there is sort of a bit of a grey area. Are the Chinese just buying these things in the black market, grey market, whatever market it is? Is there a guy, is a teams of people all over the world just taking on these GPUs and just shipping them, into China?
And what's the downside? What's the downside of them being sent to China?
The downside is that the US government does a complete audit on this. Now, if they do a complete audit on Nvidia and they say, by the way, all this stuff that's being booked in Singapore, it's not going to all these US corporates, it's actually going into the ecosystem of China, then they might come out and fine Nvidia tens of billions of dollars, tens of billions. So these are real risks of investing in Nvidia. Now, I trust Jensen enough to think that he is, it is correct what he's saying. But also, I realize that, how does he know? How does he really know where these GPUs are going? And if the American government want to make themselves $500 billion by fining him, they will. So,
Do you think this go on?
So these are just risks that investors need to be aware of.
Do you think this AI trend, obviously it's going to be this big wave, it's very different to, sort of the crypto bubble from a couple of years ago, the metaverse bubble from a couple of years ago, and, nothing really happening since then. Obviously crypto's now doing better, compared to 2021 and then the crash subsequently from that. But, is AI as big as we all say it is? And that doesn't just mean that the overall wave will happen, but there's obviously going to be a lot of losers. Like, have you started to see many of the losers from AI come about? Because even from a VC perspective, I was actually speaking to a friend the other day, and he was saying that someone he knows ran an experiment where he basically reached out to all of the top VC companies, said, hey, like, I've got a degree from Stanford, I've got a degree from Duke, I'm really interested in AI, I'm building a business about this. And they threw money at him without even properly looking at the financials or the business plan, of which there was none. Like, are you finding this with public companies as well? There have been losers to AI, even with this new wave coming about. I'm more just asking this question from a perspective of, we know this is the next big wave. We're seeing unprecedented amounts of money being created, value creation. And is this just going to be all boats sort of rising sort of situation? Or is it going to be a few winners? And have you seen any boats sink? Or is everyone just winning at the moment? And this is a natural thing that will occur a few years down the line?
I think we've had our sort of iPhone moment with it. I think it was 2000, 2007, 2008. Steve Jobs stood on stage and presented this thing called the iPhone, which was incredible. And really the iPhone 1, 2, 3, 4 were just mega products. And then really the evolution of the iPhone, if you look back at those old phones, yeah, they do feel quite old, they're quite heavy. But I think the incremental advances in AI are sort of now at iPhone 3, iPhone 4 level. And I think what you're going to see is you're going to see AI slowly over the next decade, businesses that upscale that and use that as a competitive edge will win. Businesses that don't embrace it will lose. And, if you look at, say, just the banking sector, the banks now are just signing very big contracts with things like Azure, Microsoft, I think Deutsche Bank. They mention all these big businesses. You just think of the data sets that sit within banks. It's absolutely gigantic. And banks themselves could be the biggest beneficiaries of AI. They can probably reduce the number of personnel. They can get to know the customer more. They can probably upsell customers more. And I think we're at the beginnings of a severe bull market in how banks use AI. And, that could lead to PE attraction. So I wouldn't have said this about banks 4 or 5 years ago, that they could be big beneficiaries of AI. But I do think about this about banks now. The ones who adopt it and use it and leverage it, I think are going to be the winners, and the ones who don't will lose. So as an investor, what I do is I look at all my investments and I say to myself, are they embracing AI? And how are they doing that? And how's that making the product better? So, a perfect example of that is Booking.com. Booking.com is seriously leaning into AI. I listen to all the conference calls. They've been talking about AI for a long time, and they're really ahead of the game. They can now grow their business without really taking on many more people. So they are leveraging AI. Uber is another example. Uber is significantly leaning into AI. So, the winners, will keep on winning, and the ones who embrace AI will win. But as far as where we are at the evolution of AI, I think we're sort of at iPhone, 3, 4.
I think quite a big benefit of the media is without actually, skin in the game, they can keep printing out articles, as the cars do well, or unemployment rates rise or fall or whatever. So there's just this infinite amount of information of everything going on. And by looking at stuff in hindsight, it's obvious as what could have occurred. But from an actual investing standpoint, with skin in the game, you either win or you can lose, right? And I know that's a very simple zero-sum way of putting it. If you were an LP, an endowment, or someone with a very large amount of money, and you were looking to invest your money over the next 10 to 20 years, what sort of things would you be looking at? Would you be looking more at hedge funds, private markets? What sort of investment vehicles would you focus on? I saw an article, I think today, that Millennium was thinking of selling 10 to 20% of the stake through Goldman Sachs, which would be available both to Goldman Sachs but also potential clients. So from an LP level, what should they be looking at? Should they be looking at just performance? Should they be looking at smaller hedge funds like yours? Should they be looking at things like Millennium? What does the results matter? Do they not? Like, what should be the viewpoint of a big investment fund, endowment, LP, etc., over the next 10 to 20 years, and how they invest their capital?
So this is the big institutions, not the sort of man on the street.
Big institutions.
Well, I think, the big institutions just need to have some type of diversification, but they still need to be generating, in my mind, 6 or 7% returns. So it matters where you are on the risk profile of this. Some of the big endowments, certainly like the big university endowments, like of, they're under pressure at the moment, but they also pay out a lot of money. They've got inflation, inherent inflation with sort of future education and getting the best of the best people and all the infrastructure around that. So these endowments need to probably grow at 6 or 7% a year, and that's quite hard. So you do have to take some risk. Now, if you do want to take risk, you need to be in the equity space. That's where you're going to get your sort of big winners. And you need to probably have a little bit of private equity, but I wouldn't say huge amounts. And obviously, you've now got sort of long-term bond markets, giving you sort of decent returns, 4s and 5s for 30 years. So I just think it's a mixture of both, and it's up to those endowments and institutions to decide, what risk profiles sort of suit what their sort of payments are going to be in the future. I don't know if that answers the question, but it always comes back from in my mind, just get into strategies you understand, and you understand the risks they're taking. That's key, really.
I think there are two sort of main ideas in my head of why I asked that question. One being from a point of, with an increase of retail investing, more hedge funds popping up than ever. And on top of that, with, I think 60% of hedge funds fail within 5 years. Where should they be investing? More from a point of, will the returns decrease over time as there are more market participants? But then if you look at a firm like Citadel or Millennium, so Millennium I think have received, got more than 10 to 20% over 20 years. Citadel around 20%. are these large returns possible consistently over time with minimal drawdowns? It sounds from an outside perspective, it sounds like this impossible thing that these firms are achieving, as I'm sure you do within your own firm. But it's sort of like, is this a thing of the past when you can expect such high returns? And will these returns be squeezed out by increased market participants? Or is that, the history will dictate the future and that high returns are available on a large scale consistently moving forward?
I think the returns of the S&P now are not going to be as high. We've now got Nvidia at 4.5 trillion, Microsoft at 4 trillion, the Amazons, the Googles. If you think about all those businesses, I don't know what the combined market cap is. What is it, around 10 trillion? More, in fact, 15 trillion. You've got 40% weighting in sort of the top 10 businesses in the S&P 500. And then you look at the valuations of these businesses, they're all 30 plus times earnings. So therefore, going forward, for Nvidia to double from here, it's going to be over 8 trillion. I'm not saying it can't do that, but I'm saying, that even now, the valuation of Nvidia is greater than the whole of the DAX, the CAC, the FTSE, and the Italian stock market. So is it going to double from here? Probably not. Will it see increased competition? Probably. So I would say the risk curve of the S&P 500 now is as high as it's been. And that's why indexes like the HSI index is doing so well this year, because there's a mass underweighting and the valuations are far less. So for a money manager now, you need to be much more global. These stocks have got massive risks. We talked about them. I'm not saying they're going to come through, but there's now significant risks in aligning completely with this S&P 500. You really need to make a call on those Mag 7. Now, it's never been like that before. You haven't had to make a call on the Mag 7 to invest in the S&P 500. So for me, the risks are now completely skewed in investing in, say, a tracker of the S&P 500. And I think the returns in the next 5 to 7 years are going to be far less than the preceding.
Do you think you would still agree with that if the S&P was on an equal weighted index?
Yeah, I think there's parts now. I'm buying US house builders. I personally think we're in, don't fight the Fed. It's a well-known saying in markets, but the housing market's on its knees. You can buy these businesses at book value. They look really good, risk to reward bets. I really like the mining sector. I think we're going to have a sort of a weaker dollar environment. And the metals are very difficult now because of sort of what's going on in the world. We haven't had a bull market, a proper commodity bull market for a long time. I think the peak of the bull market was 2011. I personally think now commodities look much better bets. If you look at things like Barrick Mining, that stock was up 22% last month. Lennar, US house builder, I think it was up 17% last month. But if you look at Amazon, it was down 2%. And I personally think retail and investors are too overweight Mag 7. Now it's all about looking at other stocks outside of that. And that's where the money's being made. It is being made. I know it's being made because we're there. And I think this Mag 7 is a massive distraction.
You've basically answered my next question already, but I wanted to ask you simply, what's the trade?
The trade is buy commodities, buy interest rate sensitive names in the US. I would be playing the dollar from a bearish angle. I would be owning gold, and yeah, I think try and avoid things like Nvidia, try and avoid things like Apple, try and avoid stocks like Tesla. They've got a lot to prove, and they're expensive.
And what about Bitcoin?
Bitcoin it's a tough one because, if we get to a point in 2032, 2033 where sort of the financial experiment of pumping GDP, lowering interest rates doesn't get the US economy into a position where it can sort of withstand its debt pile, then Bitcoin's going to explode higher. So for me, Bitcoin is really a bet on governments around the world. Ultimately they're really badly run, and investors know they're badly run. And at some point, in the early 80s and 90s, it was businesses that blew up because they had too much debt. Now, basically, that debt is transferred now to governments, and they've all got too much debt. COVID was a disaster for them because they just borrowed so much money. And we all have to pay it back at some point. Now, if we can't pay it back and long-term interest rates skyrocket, then Bitcoin is going to be very, very much north of here. So long-term Bitcoin is a play on governments blowing up.
What about the basis of wars? Obviously, you've got Ukraine and Russia. You've got what's going on with Israel and the wider region. Stocks such as Palantir have done extraordinarily well in the past 12 months. Do you think that war-focused, defense-focused stocks will continue to do incredibly well over the next 3 to 12 months?
Yeah, I think,
What's your sort of thoughts on that?
yeah, Palantir, what stocks do very well is where you don't know what the TAM is, total addressable market. Now, the reason why people went wild about Tesla is they didn't know the total addressable market, and they still don't. Now he's moved that rhetoric from cars to robots. Now, robots' total addressable market, nobody knows. So because nobody knows, people just get excited and they overestimate. Now, if you look at Palantir's on 522 times earnings this year, and they're falling to 241 times earnings next year. Now, as a growth investor, Amazon was always on 100 and 150 times earnings. Netflix was always on 100 and 150 times earnings. The sort of average fund manager would say, I can't pay 150 times earnings for something. But actually, it was right to do that because the earnings came through. So you really need to say, those businesses are going to become the next trillion-dollar businesses. Now, Palantir is a 370 billion market cap. As we've discussed, it's on massive PE. But if you look at the total addressable market of this business, it's so big, nobody quite knows the number. And because nobody quite knows the number, this is never going to go down to 30, 40 times earnings. This is always going to be on over 100 times earnings because the total addressable market is that big. So for me, it's a stock that it probably will become the next trillion-dollar business. It's going to have 40 to 50% drawdowns. You have to expect that as an investor, and you have to also expect that if you're wrong and about the total addressable market and on competition coming in, you're also going to lose substantial amounts of money. So it's a stock you probably have 1 or 2% position in. I don't own it; it's too expensive for me, and I don't understand how big this market is, so it's difficult for me to value it. But I can understand why people buy it.
Is there not a sense of reliability in the fact that they have contracts directly with the US government, or does that not matter? It just depends on how much more of the market they can show up to be.
When you've got a contract with the US government, it's effectively giving you that seal that you can then go in and you can go, European governments are just about starting to look at this business. Their European business is next to zero. Now, all European businesses are looking at our Palantir, the UK government are, how big are these contracts? They're just ginormous. But the problem is also you're dealing with people who don't want Palantir. They're going to, most people, it's going to cost them the job. It's going to cost them the way they do the job. So therefore, governments are very slow to adapt because everybody sits around the table has got an interest not to have them in. Whereas, with America, they basically said you have to implement this. So, it's still, these are big markets. They're still untapped and the potential's huge, but it's hopefully that answers the question, but the runway is long.
Do you still have do you have a strong belief in the idea? I'm thinking more about from a consumer standpoint now, both looking at luxury consumer staples and also from a gambling standpoint. despite what I was saying about money in pockets, Burberry stock I think is up like 90% in the last year, for example. What is the actual implications of companies within those sectors of luxury, consumer, and of gambling? Are these companies going to do well, badly? What are your thoughts around them?
Okay, so luxury goods, I think it's in a mega trend. You've now got India. India's GDP is 4 trillion. That's now starting to move the market. Apple's telling us that they're selling many more phones there. They're coming into luxury space. You've still got hundreds of millions of people in China that are aspirational and coming into this space. So looking at the structural trend of global wealth, it's clearly in a bull trend. What's phenomenal about things like Louis Vuitton is even in a recession, they don't cut the margins. So, margins, I think, in 2008, 2010 fell down to, I think, 18% net margin. But constantly, this business always has a net operating margin of 20 to 22%. So therefore, if they can drive top line, you more or less can guarantee the profits of these businesses. And they always raise prices above inflation. So there's structural bull trended stocks. Burberry, you said, is gone up 50%. But, Burberry has got its sort of imagery wrong. The stock is down 50% from its highs. So despite it doubling, it's still down a hell of a lot. So therefore, I think if you want to play luxury, just stick with Louis Vuitton. It's got global presence. It's got, over 50 brands. It's in every market. It's the best operator. And just stick with that business. Now, I would say Louis Vuitton is probably, from a risk reward, one of the best trades out there, because the stock's down, I think, 25% from its highs. It looks like the Chinese economy is inflecting. These stocks could do very well in the next 18 months. As far as gaming and gambling, obviously you've got Flutter Entertainment. They're big in the US. There's no question the US market's expanding. These businesses were number one, number two. And there is definitely a propensity to trade on sport and things like that. So again, structural bull trend. You just have to be aware with those types of businesses, there are regulatory risks.
And so have you found that even with, speaking in person to people, them saying they don't have money in their pockets, they are still spending on things which is, directly reflected into the price?
I'm saying, people now go to the sports and they do have a little bet, a little flutter, that's what people do. Certainly, sort of your generation. It was much harder for our generation to do that because you'd have to go down to a bookmaker, whereas now you can actually do it in gaming. As far as, I think what you're saying is luxury goods, I personally think we all have to remember as investors that most of the world population sits outside of Europe and US, and those regions, digitizing. They've got Instagram, they've got these apps that are very aspirational. They can see people with makeup on, brands. Brands can now engage with these people where they haven't been able to do that before. And these people are gaining wealth and they're very aspirational. So that's why luxury goods is in a massive bull trend.
I want to ask you three final quick questions. The first of which being, I've seen this intersection initially between VC and social media with the likes of Harry Stebbing, who also has a podcast with hundreds of thousands of followers or millions of followers online, which led him to raise his own fund of more than $400 million 2 years ago. But more hedge fund managers, for example, like Bill Altman, posting a lot online. What sort of impact do you think that, hedge funds, investment banks will have with social media moving forward? Do you think there will be a stronger relationship between the two? Or do you think that banks and most hedge fund managers will want to stay private moving forward?
It's difficult because it matters what. It's a difficult question. All I know is in the last 5 years, podcasts really weren't around. Before COVID, podcasts didn't exist. I see many more managers now on podcasts, and ultimately people like talking about themselves, don't they? They love talking. Well, they do. It's a structural trend, and we're all sitting in offices and we're all working from home, we're all remoting, and people like this engagement. This whole engagement's changed, and podcasts is clearly in a bull trend. and really to get your message out there instead of being on a soundbite and being asked sort of scripted messages. People just like the whole relaxed thing of podcasting. So I personally think, podcasting is in a bull trend. There's going to be certainly hedge fund managers and money managers and private equity people who will certainly engage. And yeah, I think the genie's out of the bottle, and it's just going to get bigger and bigger.
And I think just to add to that point, I think previously when you had people that wanted to short, they'd have to produce a report and get it out. Really, it'd be really difficult to get it out. But it sort of democratizes it so that not only big fund managers who have access to media can publish a certain storyline that fits their narrative, but anyone from a hedge fund manager down to a man on the street can say what they think and what they believe. And so the narrative becomes more real time. And so actually by not engaging in the narrative, you're putting yourself out of it, which actually gives you less power. My penultimate question was, is there a question, topic, trade, or thing that I haven't brought up in this podcast that you think is pretty important to mention?
Yeah, I think don't get too US centric. Don't get too Mag 7. I think we've discussed that. I think look outside the world. Valuations are so much better and the risk to rewards are so much higher. If everybody just gets out this mindset of what the Fed's going to do and what Nvidia earnings are going to look like, and we've sort of discussed it, and in some ways it frustrates me.
And my final question, and is basically a continuation of the question before, but from a retail investor or even from a hedge fund manager perspective, we're now, I'm in Australia, it's the 1st of September. Over the next 4 months closing into the year, what do you think are the big themes, important? You mentioned jobs coming out soon. What are the most important things in the next 4 months that you think will have an impact on the year? What are things that people should keep an eye out for moving forward, and the potential implications of that?
Okay, so the big risk is tariffs keep on leaking through, inflation keeps on ticking up, and we don't know where it rolls over. And I think there's a lot of discussion on where we think that's going to be. I still don't know the answer to that. I think we need to get some type of deal settled in Ukraine, and because it's got big implications for the price of oil. We don't want that in the Middle East. We want that to settle down. We don't want oil back up at sort of $75, $80 a barrel. So, those talks are really important. And yeah, really, it's a case of geopolitics not taking too much center stage, and really what's showing through the last sort of set of earnings numbers is businesses are ticking along. They're coping with the tariffs well, they're coping with geopolitical risk well, but hopefully that's a bit more rear view mirror and that doesn't sort of spike higher. And ultimately the biggest risk is if China and America have a big fallout and all of a sudden that turns nasty, that's going to cause big implications.
Thank you very much, Stephen. It was an absolute pleasure to have you on the first Personable Markets episode.
No
I
problem.
think for today, I kind of tried to hit a variety of topics, this being my first podcast focused purely on markets, but I think you answered every question fantastically. And I think there's a huge amount of value from anyone from a first-time investor all the way up to one of the top hedge funds in the world. And yeah, if you want to get in contact with Stephen, I'll put his links in the description, both from an LP level or, just curious about what he does. Stephen's very smart, as you can probably tell from this podcast, and we'll be releasing a more general episode with him coming soon as well. So thank you so much, Stephen, for coming on the podcast. It was an absolute pleasure to have you on today.
No problem. Have a good week. Cheers.